In 1930, while banks collapsed across America, one asset quietly rose more than 100%. Not stocks, not real estate, not even cash. Gold miners, tiny, dusty companies digging metal out of the ground, while the entire financial system was breaking apart. And that's the strange pattern nobody talks about. Every major depression destroys wealth differently, but certain assets keep reappearing on the winning side of the chaos. Not because they're magical, not because investors suddenly become smarter during crises, but because depressions expose what the economy was actually built on in the first place: debt, energy, trust, food, and money itself. Right now, most people still think a depression means everything goes down. History says otherwise. Some assets don't just survive, they double, sometimes triple, usually while everyone else is distracted by the collapse happening in front of them. And the uncomfortable part? The winners are rarely the assets people were told would protect them beforehand. Because during every depression, the story changes. Governments change the rules. Currencies behave strangely. Investors panic in waves, and suddenly, the thing that looked boring for 10 years becomes the only thing anyone wants. The Great Depression, the 1970s stagflation crisis, Japan's lost decades, the 2008 financial collapse, even the inflation shock after 2020. Different crises, different headlines, same pattern. A handful of assets exploded upward, while confidence disappeared everywhere else. And once you understand why, you start seeing modern markets very differently. Because depressions are not random disasters. They are stress tests, and stress tests reveal what the system secretly depends on. The first asset is probably the most misunderstood one of all: gold. Not the shiny metal on a necklace version, the monetary version. The version governments pretend stopped mattering decades ago, while central banks continue buying thousands of tons of it anyway. That irony alone should make people uncomfortable. During the Great Depression, the U.S. stock market fell nearly 90% from peak to bottom. Entire fortunes vanished. Banks failed by the thousands. People lost savings they assumed were safe because deposit insurance barely existed yet. But gold didn't collapse with everything else. In fact, after Franklin Roosevelt revalued gold in 1934, its official price jumped from $20 an ounce to $35. That's roughly a 75% increase overnight. Gold mining stocks went even further. Some doubled, some tripled. A few became absurdly profitable because their costs stayed relatively fixed while the value of the gold they extracted surged. Imagine the psychological whiplash: factories shutting down, unemployment exploding, breadlines forming. Meanwhile, a company digging rocks out of the earth becomes one of the best performing investments in America. It sounds irrational until you understand what was actually happening. Depressions are usually debt crises disguised as economic crises. Too much borrowing, too much leverage, too many promises that only work if growth continues forever. Then, growth stops. And suddenly, everybody wants safety at the exact same time. That's where gold changes character. During good times, gold looks useless. It produces nothing, pays no dividend, just sits there. During monetary panic, that uselessness becomes the entire point. Gold has no counterparty risk, no CEO, no earnings report, no bank balance sheet, no government promise attached to it. In depressions, trust becomes valuable, and assets requiring the least trust suddenly matter most. That pattern repeated again in the 1970s. Inflation surged. Oil shocks hit the economy. Stocks stagnated for nearly a decade in real terms. Gold rose more than 2,000% across the decade, not because civilization ended, because confidence in paper currency weakened. That distinction matters. Most people think depressions are only about unemployment, but many depressions are really currency events first, economic events second. And when currencies weaken, hard assets reprice violently, which brings us to the second asset, energy. More specifically, oil. Now this sounds backwards. Why would oil perform during depressions if economies are slowing down? Because energy is not optional. Modern civilization runs on concentrated energy the way the human body runs on oxygen. When economies weaken, demand falls temporarily. But when monetary systems crack, energy producers can suddenly gain enormous pricing power. The 1970s exposed this brutally. Oil prices exploded nearly tenfold during the decade. Entire industries struggled to survive under rising costs. Meanwhile, oil-producing nations and energy companies accumulated extraordinary wealth. There's a dark irony here. During prosperous periods, people treat energy like background scenery, gas stations, power lines, cargo ships, just infrastructure. During crises, everybody remembers the economy is actually physical. Food must move. Factories need power. Machines need fuel. A financial system can become digital overnight. An energy system cannot. That's why energy shocks are so dangerous during depression. They attack both consumer confidence and production capacity simultaneously. And once inflation enters the system through energy, it spreads everywhere. Transportation, manufacturing, heating, food. Almost everything modern people buy contains hidden energy costs somewhere in the chain, which means energy producers can become accidental winners during economic pain. Again, not because the economy is healthy, because the economy is stressed. There's a difference. Now here's where things get even stranger. The third asset wasn't glamorous at all. Farmland. Actual farmland. Soil, water, crop production. The kind of asset most investors never think about until grocery prices suddenly become political. During inflationary depressions and monetary instability, farmland repeatedly outperformed financial assets. Not every year, not smoothly, but over long stretches of uncertainty, productive land became extraordinarily valuable. And the reason is almost embarrassingly simple. People stop buying luxury goods during crises. They do not stop eating. Agriculture sits at the intersection of necessity and scarcity. There's only so much productive land, only so much fresh water, only so much reliable crop output. And unlike tech stocks, farmland cannot be printed by central banks. That becomes important during periods when governments respond to recessions by creating massive amounts of money, which they almost always do, quietly at first, then aggressively, then all at once. After 2008, central banks flooded the financial system with liquidity. Interest rates collapsed toward zero. Asset prices surged, but something else happened beneath the surface. Institutional investors began buying farmland globally, not because farming suddenly became exciting, because large investors started realizing food production behaves differently from financial speculation. It's tied to physical demand, real demand, not app download, not social media engagement, not quarterly narratives, calories. And once inflation accelerates, farmland often reprices upward because food prices eventually follow monetary expansion. There's another uncomfortable detail here too. Historically, societies become politically unstable when food becomes expensive. That means farmland isn't just an economic asset during depression. It can become a strategic asset. Governments know this, which is why agricultural subsidies, export controls, and food policies become extremely aggressive during major crises. The fourth asset is where the story becomes deeply ironic. Cash. Not holding cash forever. That would be disastrous during inflationary periods. But during the early phase of depressions, cash often becomes king temporarily, and almost nobody understands why. In boom times, debt expands rapidly because everybody assumes tomorrow will be bigger than today. People borrow. Businesses borrow. Governments borrow. Investors use leverage because rising asset prices make leverage feel intelligent. Then the cycle reverses. Assets fall, debt remains, and suddenly, cash becomes scarce. That's the critical part. Depressions are often liquidity shortages before they become anything else. Everybody scrambles for dollars simultaneously to pay debts, margin calls, and obligations. That's why even good assets initially crash during severe downturns. People sell what they can, not what they want to. In 2008, investors sold stocks, commodities, real estate investment trusts, almost everything. Not because every asset suddenly became worthless, because the system desperately needed liquidity. Cash gains power during that phase because deflation increases the real value of money itself. $1 suddenly buys more assets, more labor, more property, more desperation. That sounds cold because it is cold. Deflation rewards liquidity while punishing debtors. But here's the twist most people miss. Governments hate prolonged deflation because modern economies are built on debt, and debt becomes mathematically harder to repay when money gains value over time. So, central banks intervene aggressively. Rate cuts, money printing, stimulus, asset purchases, which eventually changes the game entirely. Cash dominates the panic phase. Hard assets often dominate the response phase.
And understanding that sequence may be more important than predicting the depression itself, because timing matters a lot. Now, the fifth asset may be the most controversial one. Not because it's new, because it exposes how financial systems actually function. The asset is government bonds. Yes, government bonds. The same thing many investors now dismiss as boring relics from another era. During deflationary depressions, high-quality government bonds historically performed extremely well. In some cases, spectacularly well. Why? And understanding that sequence may be more important than predicting the depression itself, because timing matters a lot. Now, the fifth asset may be the most controversial one. Not because it's new, because it exposes how financial systems actually function. The asset is government bonds. Yes, government bonds. The same thing many investors now dismiss as boring relics from another era. During deflationary depressions, high-quality government bonds historically performed extremely well. In some cases, spectacularly well. Why? Because when fear explodes, investors prioritize return of capital over return on capital. That tiny wording difference changes everything. In panics, large institutions want safety, liquidity, and predictability. Government bonds, especially from stable countries, become shelters for enormous pools of capital. During the 2008 crisis, U.S. Treasury bonds surged as stocks collapsed. Yields fell sharply. Bond prices rose. Capital rushed toward perceived safety. Again, this feels backward emotionally. Governments caused enormous debt expansion, then investors rewarded government debt during the collapse. But financial systems are often circular like that. Investors run toward the entity most capable of printing currency during emergencies. That doesn't mean bonds are always safe. Far from it. In inflationary depressions, bonds can become disasters because fixed payments lose purchasing power rapidly. That's exactly what happened in the 1970s, which reveals the deeper truth hiding underneath all five assets. No asset wins during every depression. The winners depend on the type of collapse unfolding. Deflation, inflation, currency crisis, banking crisis, energy shock. Each one reshuffles the hierarchy. And this is where modern investors often become dangerously confused. People search for the best asset. History suggests there is no permanent winner. Only assets aligned with the pressure point breaking inside the system. Gold thrives when trust in money weakens. Energy thrives when physical scarcity dominates. Farmland thrives when inflation collides with necessity. Cash thrives during liquidation panics. Government bonds thrive when fear overwhelms growth. Different